What's going on, YouTube? In this video, we're going to talk about Servicenow, ticker symbol NOW. We're going to take a look at a couple news articles written on this company and the future outlook of what this company could hold in terms of revenue, which is pretty interesting, really. And then we'll take a look at the valuation spreadsheet and see what Servicenow is valued at today, and then make a little bit of an educated guess as to what the future could potentially hold for ServiceNow in terms of value. Then right after that, we'll look at the stock chart and see if there's any technicals to be traded. So year to date, ServiceNow is up 50% over the course of 1 year, 33. 5 years is up 200%. So one of the questions I always ask myself when I was doing some digging on this company was, what does this company do? And the best answer I could find that made sense to me was this guy's response. So ServiceNow is a cloud-based workflow automation platform that enables enterprise organizations to improve operational efficiencies by streamlining and automating routine work tasks. So with roots in IT service management, ServiceNow has evolved to become the enterprise service management platform for organizations, uniting all businesses functions from customer service to HR to security and more, which we'll see here in a minute. They do offer a lot of different services. ServiceNow is one of those rare software platforms that can show a rapid return on investment and continue to deliver strong value as the organization expands its use. That to me sounds very moat worthy, right? Like they've got some pricing power. All right, so the first article we're gonna go through, this guy's bullish on it. He's got a buy rating on it. His name's Julian Lin, on Seeking Alpha. So we come down here, he did a little bit of some numbers for us. So as of recent prices, now trades at about 55 times earnings. I think it's at 58 right now. That might look expensive, but they're saying that revenue growth for the next like 3 years, with a good slew of analysts averaging out to about 22% for an average revenue growth. So good, right? So it is worth noting that consensus estimates have now blowing past 2026 guidance with nearly $16 billion in revenue. Currently, we're doing about $8 to $9 billion in revenue, and they're expecting by 2026, so in 2 years, to almost double revenue, right? So within probably 3 years, they're going to double their revenue. So based on 20% growth, 40% long-term net margins, and a 1.5 price to earnings PEG ratio, could see the stock trading at around 12 times sales. That implies a stock price of $930 per share by the end of 2026. So that's pretty bullish to say. Let's see if we can maybe back up that 20% growth, right? Let's see if we can agree with an analyst's expectations of 22% growth. But before we do that, let's look at this next argument. This guy, Gary Alexander, he had two key points to just be aware of in terms of negative stuff. Is aggressive headcount growth is limiting margin expectations. So we'll take a peek at the financial statement and see if that's true, and by how much is our, you know, G&A increasing by. And then saturation, he's saying that, ServiceNow services 85% of the Fortune 500, and it has already expanded overseas, with international contributing to 1/3 of its company's revenues. Okay, so he's saying that they might be nearing the end of their growth stage and now gonna be more of a, I guess a blue chip type stock, right? Where growth is gonna continue to slow down in the foreseeable future is what he's concerned about. All right, so next article here, which this one is really interesting in my opinion. This was just a news article on Seeking Alpha. So ServiceNow has several new software offerings, and also they've got a partnership with NVIDIA and Accenture. And they're saying with this new software offerings could result in significant value creation for both customers and the company. So what they're doing is their focus is a value creation. We're expecting a price uplift of 60+%. So what they're doing is they're going to offer on each one of their, well, not each one, but they've got offerings coming in for their IT service management, customer service management, HR service delivery products, and those are released sometime this month probably. Those offerings come in a good, better, best, right? So those good, better, best here are going to be, there's a standard version, which is probably what it is now, just a standard version. The Pro and Enterprise options embed artificial intelligence and machine learning capabilities at higher price points. So basically, Now they're going to offer, at least on those three areas there, which to me seems like the three main areas of any business is IT, customer service, and HR, right? I mean, that's like your three core main areas for any business. They're going to offer two more scalable models in terms of like better model or better software, better platforms for these customers. And they're going to have them as, incorporate AI and machine learning capabilities into these and increase the price by about 60+% roughly, right? So if you've got a lot of customers that are in the Fortune 500, they've got money and they're probably more than willing to pay for this. They have a 99% return rate on customers. Pretty bullish, right? Like that kind of answers the first guy's question, right? Saying like, okay, is 20% kind of sustainable? Probably if they're going to offer this. And I think a lot of companies are going to see this, they're going to test it out, and they might love it, and they probably are going to buy it, especially if it does help out with productivity and automating things even more and making and saving time and making more money with it. So real quick too, like that's just three areas. They offer all of these things. These are all their different types of softwares that they offer to companies. So it's not like they've only got like 10, right? They've got, I don't know, looks like 100, maybe more. So, and they also offer the into just about every industry too. So, oh, pretty interesting. So we're at the financial statement now. We're coming to our balance sheet. Currently, really, all of our balances here equal out to be relatively flat. We did see a decrease in their accounts receivable, which just means their customers are paying their bills, which is always a good thing to see. And otherwise, everything else is relatively flat. No big changes there. And this is in 6 months. Deferred tax assets, we can see ticked up about 900 and I don't know, 15-ish bill. But other than that, there was no real major change within any of this. Overall, we're up 1.7 bill in total assets. Total current liabilities down about 250, and then total long-term liabilities or total debt really is also just down about 250-ish, 260. Retained earnings ticked up to 1.5 billion. Stockholder equity is up to 6.9 billion. Subscriptions are up nicely at 20%. Gross profit, we're sitting at 81%. And here's where things take a turn is basically all of our operating expenses just soaks up everything. We can see we made 3.3 billion. We used 3 point almost 1 billion of that. So, that leaves them with $261 million in income from operations, right? However, that one guy, that one news article, Gary, said that their head count is increasing. Okay, well, general administrative, we went from 354 to 408. I mean, $54 million in headcount is nominal when you're doing $3 billion in sorry 3 point we're doing $4 billion in revenue. So I don't see that as a very valid argument. We do have R&D up and we do have sales and marketing up, but those two both are to grow the company, right? Obviously we don't want to see these exploding like we can see them. They are still climbing quite a bit. You really would like to see them flatline and try and see if they can't grow the business more. Hopefully with in the next 2-3 years, like they're potentially predicting is we're gonna be doing about $8 billion, or sorry, $16 billion, which would be about $8 billion up here. And maybe those will stay relatively flat compared to where they are now. And then this company really start pumping out some money. So, we'll have to wait and see if that's will come to fruition. I can't imagine this is going to keep climbing too much more, but we'll see. Share count, we got slightly diluted, but that's like 1%. Nothing to be too concerned about there. We got a benefit from taxes here of $832 million. So we add that into our right here, our income before taxes, 362. So now we got $1.2 billion. So we get to bring just shy of $1.2 billion to the net income. So over here at the cash flows, 1.2 billion right there. Stock-based comp, 778. Really would like to see that slow down. However, it's not killing the dilution too much. It's only 1%. Obviously you'd like to see 0 or less, but it is a growing company. and they might still need some of the cash, right? They might feel comfortable giving out the stock-based comp. Deferred income taxes, we saw we had a benefit of them, so then that most of that and then some gets reducted out of cash flows, so that kind of puts a line through both those items. However, net cash provided by operating activities we can see is 1.5 billion. Basically, half of that is from stock-based comp. So really, from cash from operations, we made about 700-ish million in 6 months. But we take our cash from operations, 1.5 billion minus 300 million from CapEx gives us a 1.185 billion free cash flow, or 2.37 billion free cash flow annualized. Pretty good. Pretty good. Balance sheet overall. Couple things I don't like is stock-based comp. I don't like seeing benefits from taxes, but because it kind of skews the numbers all overall. And if they can just control their operating expenses, those are the only three things that really are, like, I wouldn't even call them concerning, but just things you'd rather not want to see. Now we're coming over to the valuation spreadsheet. We're going to look at company statistics real quick, roll into the value ratios, and then into the calculator and find out what this company's worth. Market cap, 118 billion. Enterprise value, 115 billion. No dividend payout. We have return on equity of 25%. We'd like to, and that, which is good. We'd like to see 15 or more. Return on invested capital sitting at 9. We'd like to see 15 or more, but we will see that this is trending in the right direction. Shares up 1%. We saw that. Analyst forecast on this company have $598. They're forecasted 5 years revenue growth 21%, 5-year EPS 68%. We got margins here as well. We got 78.5% gross margin, operating margin 6.3%. So that's where we'd like to see that turn around. But profit margin, we're up 17.7% there. So right here, one thing on the EPS, why that's at 68% is I don't know why there's 529%. I mean, it makes sense because they're going from 1.6 to 10, right? But we're gonna change that when we do our valuation, because that's gonna just throw everything way out of balance. So we're gonna probably put in a different number, maybe 50% or something like that. So that way it doesn't screw these numbers up too much, right? So overall, looking at company statistics, the only thing again is this operating margin. If they could fix that and make it stronger, a higher percentage, that'd be great. And their return on invested capital, if they can get that up to 15%. But again, it's not concerning because it is trending in the right direction. So here's two different ratios to look at. We have return on invested capital, so as I was just talking about, down here we're going 20. Our overall trend is in the correct direction. And then enterprise value, you can kind of see where that's trending as well. Peter Lynch valuation. So here's our EPS that I was talking about. So I put 23% in. You know what? I said 50, so we're going to do 50%. So 50%, that gives us an EPS growth rate of 32% for 3 years, by the way. 3-year revenue growth rate, 22%. Gives us a Peter Lynch fair value of $222 per share. Multiples comparison, we have 4 different multiples to compare to. It gives us a fair market value against its peers of $551 per share. Our manual PE, we have $118 billion market cap, cash 4.7, debt 8, cash from operations 2.9 billion. Gives them about 42 years before they can earn their current market cap. Price to book sitting at, they got 15 billion in assets, 8 billion in liabilities, outstanding shares 205. Overall price to book 17, 5-year average 26. Pretty good. PEG ratio 3.7 and forward looking 2.1. Very richly valued based on the PEG ratio here. Grams valuation, we've got all of our numbers punched in. Really, this should be a 0 because they are quite a growth company still. But when I put a 0 in, it gives them a $52 valuation. Obviously, I don't think that's very accurate. So we're going to give them a 1 and give them a better intrinsic value rating, in my opinion. Weighted average cost of capital, 8.49. Comes over to here for our DCF valuation, 8.49, perpetual growth rate of 2.5 with a growth rate of free cash flow of 22%. So analysts have 22%. The average growth rate's been 35.57%. We can see our cash flows, cash from operations. Well, we'll just look at our free cash flow growth rate here. So we 492, 509, we're growing, and growing, going in the correct direction. Not one year where we go the wrong direction. So overall, good growth. So we come down here, cash market securities gives us a DCF price per share of $420. Rule 72, EPS 694, current PE 83.43. Our lowest EPS growth rate, we had 31.98 on our valuation spreadsheet, and Yahoo Finance we has 25.6% EPS growth rate in 5 years. These are both 5-year comparisons. And so we're going to use the lowest one of the two. And 25 goes into 72, 2.8 times. 2.8 goes to 10 years, 3.5 times. So we come down here. We can see our EPS after 3 times multiplying it, 55, and then we got about a half, so half between 3 and 4. I gave it 65. 65 for a fair value gives us $832 with a 30% margin of safety, $582. So currently we can see over here at our summary, all 5 of our valuations giving us an average price of $455 per share with a purchase price of $319 per share. If you wanted to, you could remove this Peter Lynch valuation and Benjamin Graham valuation. And that you can see gives you $600 per share with a purchase price of $420 per share. So if that's something that, some people want to see, you can kind of give an idea if you take out those two small numbers that are kind of pulling you back when you can look at some of these other 3 numbers based on kind of where it's kind of currently trading. And on top of it, if we do that, if we get rid of that and get rid of that 601, we can see also our price target for analysts is at 594. Now I don't want to skew my numbers to analysts because we don't know where they got their numbers from, but we can add, I like to add in more variables than less. So that gives us a fair price, an average fair market price of $455, purchase price of $318 per share. Now, however, we did note that in these articles, we could see the potential of what is coming in the future for this company. And it's not like they're growing and trying to acquire more customers. They've already got the customer base. Now they're going to expand their services into the AI sector, which honestly is if you've taken a look at some of the AI software out there, like look at Microsoft Copilot, like look into that and see what that's going to do for companies, and then you can only imagine whatever they're going to implement into their software or programs or workflows, what they're going to do for their companies. They're already very successful at what they do, and then on top of it, they're going to add AI into it. I think there's lots of potential for more revenue coming in. So my take on it, I like it actually. I like it a lot. I know 455, this is a company I'd be willing to pay fair value for based on what I'm seeing, the numbers, um, the growth. It's got the customers, it's making money, and if it can just keep its operating expenses down, I think this company have no problem reaching $800 a share. If it's gonna double its revenue in 2 years, in theory, some of that's already probably priced in, right? So let's say in 2 years, if it doubles its revenue, and let's say 25% of that's already priced in, you take 25% off of $580, you could probably say this company could very well be valued around $800 a share. It's probably, if those 2 years wasn't priced in, this is probably what you're looking at, right? For a fair market value, 455. It seems very accurate, but then they're pricing in the future. You can say, okay, well, it looks like you're going to double your revenues. So obviously everything else within the company is going to grow with those revenues in terms of actually producing money, and hopefully some things can get reduced like debt and the overall operating expenses a little bit as well. So you could say this is a four or an $800 to $900 company in the next 2 years. Honestly, it seems very valid to me. But let's take a look at the stock chart. We can see right now is probably at a resistance point. You can kind of see how much it's up. It seems like it needs to take a break anyway, where if it takes a break, there's a chance its next support range would be like 480. So it's $100 away, which is kind of crazy. $100 away, and by the time it gets to it, you might already be retesting this long-term trend line on this stock chart here. So this could pull back to like 40, which would be a perfect buying opportunity based on technicals. And like I said, 455 is the number that we got on my 5 valuations. You take out those two, Benjamin Graham's valuation, Peter Lynch's valuation, it gives us $600 per share with a 420 buy range. Again, this is a company that's going to grow by the looks of it, quite a bit. It's got some big customers. I don't see a reason why this company shouldn't be trading at quite a bit of a, a premium, honestly. So if it does pull back to like 480, I really think that's a good buying opportunity on Now Services. Same difference. So that's my take on Servicenow. If you found value in this video, drop a like, subscribe, and we'll be back later with another stock analysis video.